All right, just testing, making sure everything works. Um, and yeah, so welcome back to the live stream this week. Kind of some housekeeping I'll kind of get to actually before we start. Um, so you probably noticed there wasn't a podcast this week. Been away. There's been traveling. There's been away traveling. So the podcast will resume next week. This week, I kind of wanted to talk about geopolitical risks. I've been reading a lot of things about China, Russia, and North Korea coming out of the news. But we're also seeing a lot of things happening with the U.S. Uh, and I kind of want to address geopolitical risk not from traditional like what's going on in the world, but more like what does this imply for portfolios and investors? What does this imply for people that are investing directly in commodities uh, themselves? So I mean, directly commodities, either paper trading or the physical commodities. There's been a bit of a mismatch, and I'll get to this too. There's been a bit of a mismatch, and I believe I've talked about this previously, but mismatch between what central banks say and what they actually do. What the federal government says and what the federal government tells or is discussing with the central banks supposedly behind closed doors. And so before we continue, before we dive in, don't forget to like this video, subscribe, check out the other videos. There's going to be more stuff coming in the future, more videos, more short form content. Uh, don't forget to again like, subscribe, turn your notifications on, and if you have any questions, comments, or any requests for future videos, maybe there's a topic you want discussed in a future episode of the Commodity Bro podcast, drop a comment below, or drop a comment in any one of our videos. And I guess more recent video, obviously, but yeah, drop comment and again like, subscribe, turn your notifications on so you never miss an episode or live stream. So yeah, we'll dive right in. So before I'll kind of pull this up first. I'll use this and I'll pull it up and we'll talk to it first. So geopolitical risk, just to kind of give an idea, is essentially here. Let me pull it up. I believe this is it. I pull up the BlackRock geopolitical risk dashboard. Basically, geopolitical risk is basically a quantifiable metric to gauge how severe or how light I don't know, like something like a current event might have. This could be like basically how the current events impact how they impact portfolios. So BlackRock has a handy tool, kind of just going, and it's a handy tool, geopolitical risk dashboard. It's very difficult, surprisingly, to find an API to play around with that's free. There's a lot of premium APIs out there, but BlackRock has like a handy tool dashboard here, and it basically allows. It's pretty cool actually. Let me go back. Basically allows you to I sorry. Basically, it basically allows you to see basically puts on a timeline basically so you can see here going back to 2018, 2025, and forward. I guess you can go. I guess you say going back there probably mid-year 2017, 2018. But basically, you can look at the different. I guess you can look at the trend. So what you're really looking at is so these are the major world events. But then you're looking at the line. This giant line chart is basically telling you the severity, and over time, it's showing you the volatility and geopolitical risk. But basically, what that means, these scores are basically a gauge. And if you scroll down, they have their own little analysis. I won't get into that. But what this is kind of showing us is it's kind of gauging for us the impact that, again, like I said, the impact in a given point in time that geopolitical risk, again, and they narrow it down. But geopolitical risk, for example, as a global indicator, the impact it might have on portfolio. So, for example, here in 2022, there was a spike. This is just post the invasion of Ukraine. What's funny is there is sort of a lagging effect, and geopolitical risk, in its sense, is kind of a lagging indicator when you think about it. It's all because I guess it's a reactionary effect. So, for example, I mean, if like for example, actually the October 7th attack is a good example. Actually, like you only like post October 7th, that was when we really saw uh, that. I mean, that's when that's when the flare up in the region. So the October 7th attack happened. Then post October 7th, you then automatically have all these people flooding in. I mean, all the bottlenecks happening, and then again you have all the investors that is flooding in uh, with, I guess, for lack of better words, I'm trying to place the word. They're I guess they're having a negative sentiment, for lack of better words. Without rambling, I kind of show like this is something to kind of zone in. There's a few things I wanted to touch on. I want to talk about China and the U.S. I want to talk about the Middle East, but then I want to also talk about Russia and European and I guess Russia and Europe. We'll go into kind of China, for example, now. So it's it's kind of interesting to China, I guess, strategic competition. Like, let's see. Sorry, global trade protection would be a better indicator. So probably seen in previous episodes. Like, I'll even pull it up. What's it called? U.S. Section 232 tariff. Here. So no, yeah. Rio Section tariffs. U.S. tariff classifications. There's basically three types of. Wait, 1 second. Basically, while I try to pull it up, I'll kind of talk about here. There's a few types of tariffs. Basically, there's Section 301, Section 232. Let me pull it up. 1 second. I can't believe I forgot. I'm blanking on the name of the tariff of the other one. 301 and I believe maybe this is it. Sorry, my computer's loading, but believe. Wait a second. Yeah, sorry. So Section 301. I pulled up an article. I just found an article quickly that kind of breaks it down, but so you can kind of see the article I'm looking at. But basically, there's three tariffs. The one we want to look at is Section 301. Basically, Section 301 is pertaining to China. So where was it? Yeah, we go. Section 301 addresses unfair trade practices or unfair trade practices. What are deemed unfair trade practices by the Trump administration or the U.S. government, for lack of better terminology. So these were kind of brought back. I believe they were removed, they were, I believe they were removed over the Biden administration. Trump basically reinstated a lot of these tariffs. For those of you who remember the first Trump administration or followed the first Trump administration, there was a brief tariff war, similar to what we're seeing now, but tariff war. So yeah, and kind of go back to this chart, and we can kind of see too that like there was a bit. So from the Biden administration, we saw there was a drop. There was a drop in, I guess, geopolitical risk in terms of trade protectionism. Trade protectionism, for to kind of give a bit of an understanding for those viewers listening or watching this. Essentially, that you want to. Trying to think how to explain this. It's essentially a country or a national or a sovereign entity will essentially put restrictions to protect their own interests. I mean, on the spot, that's kind of the best explanation I can think of. But we saw a massive spike in 2025. This is after Trump got in. This was like kind of the spike of the tariffs. We see like a few shorter spikes there. Again, we're seeing a lot of this volatility in the geopolitical risk premium on this. This is more of a. Don't think of this as like as what's happening in the market. Think of this more as this is a market sentiment, an indicator of market sentiment. It's no different than like, or it's a very similar in terms of like the concept as it would be to. I mean, some people might get mad about this comparison, but I'll use it because I think it's a good idea. Like kind of like the Bitcoin bull and bear. The Bitcoin like uh, like bull and bear sentiment. There's like I forgot what am I thinking of. Um, there's blanking on the name of it. Bitcoin. Um, Anyways, it's a market sentiment tool for looking at Bitcoin, and basically depending on how it'll come to me, depending on how people depending on market sentiment towards, and this market sentiment is gauged towards supply, demand, other factors, but basically the that it'll say whether it's neutral, bullish, or bearish. Think of this more as kind of like how people feel about geopolitical pricing, how geopolitical is affecting the pricing on their portfolios, uh, and how it's risking in terms of the markets, the broader market. And again, a lot of this spiking is because there were a lot of because there's tariffs being imposed and imposed, threatened, and then they don't materialize, and all these other stuff, all the other fun stuff. So there's very high. Now let's go to kind of look at the Middle East regional war, and I mean more recently, I would say there's been a bit of a spike. I mean, I don't know how I necessarily feel about this commenting. I mean, to be honest, this is a lot. This is unscripted. I'll say this because this is this is unscripted. So for those of you listening that say this guy is just reading, I'm not reading off a script. So I'll point that, I mentioned that I am a because I'm prefacing that with what I'm about to say. Like I'm genuinely shocked that the current ongoing crisis. I mean, even like the bombing of the nuclear sites in Iran. I'm genuinely shocked that didn't have. I mean, we look at the effect that had on on crude oil. It like shot up at the time. Let's pull up the price of crude oil. Um, let's see. Right, we go to let's go to. I'm gonna go to zoom out 1 year. What month? That was a cut. That's what month. Yeah, you seen. I mean, oil's been up. Let's go back 5 years. Let's kind of see. I mean, yeah. I mean, I guess that's the price. I mean, we didn't see as much of a spike. You know, wait a second. Let me look at Brent. Uh huh. So yeah, and you can see like the spiking here. I think that's more. I think that kind of. I think in the broader market sense, I don't think it had. Maybe that's why. Maybe that's kind of the comment. I think that's probably why we're not seeing as much of a geopolitical shock in terms of how it's in terms of a geopolitical shock in terms of the BlackRock indicator. But when we look at price of crude, Brent, um, yeah, that I mean, it shot up. The and I think oh, wait a second. Let's come down. I mean, let's look at more. I'll bring up your now. I'll bring up European fragmentation and actually, before I get into that, I kind of want to talk about where I'm going with why I'll segue into Europe, but back to the Middle East, back to China. You know that China more recently here I found the article in the Guardian, for example. A lot of developments over the past while. 1 second. This was from September. This is from today. Um, and here, let me pull it up. So, I mean, China had a massive military parade. Xi Jinping spoke, and he basically invited his BFFs, so to speak, Putin and what's that guy's name, Kim Jong Un from North Korea. And I mean, there's a I mean, this is an interesting mix. I mean, we know that it's no secret that these guys are kind of all friends. I mean, we got pretty much a former Soviet you got the former Soviet guy and the two communist guys there. And I won't turn this into a political podcast. I'll tie it back. I promise I'll tie this back to the portfolio to what I was getting at with the portfolio risk. But what's interesting here is you're seeing almost like a I mean, it's no secret. I think this kind of brings into the limelight. I remember when the Queen of England had passed away, and I saw it was funny that Putin, North Korea, I believe. I don't no, sorry, North Korea wasn't there. It was Putin, China, and Xi Jinping, and I've got the Iranian guy, the Ayatollah guy. They had a military exercise, and the Chinese didn't were the Chinese were invited, but they didn't actually. He sent his number. I think he sent his number three to go to the funeral, and I guess they weren't let in because again it was a high profile. Like, eventually, that's the whole other story. But and it made all the news because of that. But we haven't. This is not something that's new. A lot of people are shocked. I mean, it's not something that's new. This is more. This is more. They want to flex. I mean, China's got its own problems. They have a declining. I mean, they have their industrial sector for the growth it's seen over the past decade. So they have a drowning real estate market. They have a relatively poor economy. I mean, their industrial sector and utility sector is almost crapping out, so to speak, relative to like previous growth. And I mean, it's no secret to how supportive they are, how they're supportive of that. It's no secret that China is supportive of the North Korean regime. So, and again, this is where does Putin stand in this? I mean, Putin has almost the incentive I can see Putin getting or is getting at here is he needs the alliance with China. I mean, we've seen almost like this is where I'm segueing. This is where I'll segue into Europe. Um, and I mentioned this in previous podcast, in the Commodity Bro podcast. I believe I mentioned it last week's live stream, but I talked about Power of Siberia pipeline. There's two, the Power of Siberia pipeline. I'll pull that up. Or Power of Siberia map. Power. Let me just pull it up. I don't know why it didn't work. Power. Here. And yeah, it's just basically a new natural gas pipeline. And a lot of this was basically in response to here. I'll go to images just to see. This pipeline, this is basically a response to European sanctions, to European attempts or ongoing attempts to separate itself from Russia in terms of trade. Like for years, for decades, we've seen Europe has almost become dependent on Russian natural gas, and there was a short like, lecture. We saw that after sanctions on Russia were placed, the cost of energy in Germany, for example, I use that as an example because it just shot up. And the reason is because, or it just shot up in the air. Like we saw the price of we saw record high prices for energy prices in Germany. Let me see if I can pull something up on that, but I'll pull it up in a minute. But because I want to kind of get to that, but uh, this kind of leads to fragmentation in Europe. So, I mean, Europe, for example, let's here another article I found. Anyways, but actually, sorry, without getting sidetracked, basically, the Europeans have become fragmented because you have some of the Eastern European countries that what's the name of that country again? Um, Poland and Hungary have essentially like Poland and Hungary have almost I mean they've kind of we haven't really heard much of them in terms of like peanut gallery comments on the war. I say peanut gallery sounds kind of kind of sarcastic. I mean we haven't seen much of their commentary from them, but we see a lot of commentary coming from from Western Europe. And again, what's ironic was even with all the sanctions, they still continue to purchase Russian natural gas post. I mean, more recently. I mean, there was a brief period. I think they had levied. They had put tariffs, or they had done something there. I'm mistaken. Let me double check. Um, Let me find something. I'll pull something up after. You know what? Maybe I'll drop it in the comments after. I don't want to spend too much time, but um, basically they had I think they slowly reduced, and I guess now they're looking for alternatives. And where I'm getting at is that, I mean, the Russians have kind of gotten the message. They're building the pipeline with the Chinese. But but this morning saw an interesting article. The For example, Mark Carney, Prime Minister of Canada, for those of you who don't know, uh, is funding is essentially look is essen- here. Let me find it. He was funding an LNG terminal in I believe Newfoundland. One second, LNG. Here, $15 billion project. Here, London Crown-based LNG company, pitches $15 billion project. And Carney's a kind of a controversial guy, so I'll say that Mark Carney, if you think, I'll look at it from non-political perspective. I'll leave political views out of this, but for example, but for what it's worth, I think there's been a lot of talk, but then we're slowly seeing action on some things, but not some things on others. And whether you want to say $15 billion to fund a project is good or bad, there's trade-offs in there. I mean, Canada has its a lot of has Canada is undergoing a bit of an economic crisis currently. I mean, we have record high unemployment, record high. We just came out of high inflation, very very high inflation, and inflation's kind of subsided. But again, we're seeing low interest rates, and this is where we've seen low interest rates kind of stabilize, and this is, I think, where a lot of this is giving kind of the green light for the government to start spending this amount of money. So that's the trade off there. But Carney's also, for what it's worth, he's also been he's been heavily supportive, surprisingly supportive. I'll say this, given his that he's the leader of the official leader of the Liberal Party, surprisingly supportive of energy. And whether this is, again, we'll see what he does. It's like, I heard to paraphrase someone I heard, Carney talks a lot. Let's see what he does, and then that will be the time. In time, we'll see. I think that's the key variable here. And if this goes through, because I mean, Europe has a bit of an issue, and I think, and for those of you who don't know, actually, before I get into that, LNG is pretty much just natural gas that's been cooled down to like 132 degrees Celsius, negative 132 degrees Celsius, I believe. Negative LNG temperature. LNG. Yeah. Sorry, 100. Sorry, yeah, negative 162, not 132. Yeah, negative 162 degrees Celsius, or negative 260 degrees Fahrenheit, depending on if you're American, or however you listen to that stuff, or however you read temperatures. But um, but before we've had Kitimat Terminal come online several months ago. Then we have two more LNG Canada, and another one, like on the name, but come online in 27, 28, I believe. And if I'm mistaken, correct me if I'm wrong, but 27, 28 here. Actually, you know what? I'll pull it up. Canadian. Um, yeah, it's 2027, 2028. Here are these two. It was Cedar LNG project in Kitimat as well, and then you have the Woodfire LNG in Squamish. This one's 27. And then this Cedar LNG should be 2028. Um, and that solves the problem. That's great. This is great news. These three terminals for Asia, because not only does this give a strategic barrier buffer for South Korea and I guess NATO countries like Japan, like South Korea, Japan, Philippines, Australia. It gives them it releases them from I guess the supply chain bottleneck of having to worry about I guess navigating tariffs with the U.S. or dealing with China and Russia. But what it does, but then you have an issue where the Europeans. I mean, the only other way is to go around the Horn of Africa to Europe or go through the Red Sea, and those are bottlenecks on its own. Those provide a lot of, I mean, just the insurance on the ships. So we know insurance rates in that region have skyrocketed with the ongoing risk in that region. And again, to take the long, it's basically you're traveling half the globe. So, and again, you can't. It's not like you can build a pipeline because there's China and Russia you got to worry about. So again, this project in Newfoundland is significant because it gives it's bringing putting Canada on the map in terms of we have an abundance of natural gas and we have and we're not exporting it. Our major customer for years with the U.S. and I mean, there's trade-offs. There's good things and there's bad things that come out of these trade wars. Good thing, I think if you want to look at things from a positive perspective, it's and this is what kind of forced the trade. I mean, you know that Kitimat terminal, the one that came online several months ago in BC, that that sent its first shipments to Japan and South Korea, and and again that was because of the U.S. tariffs. And so when it goes to so again, this is an opportunity for now for us to sell our LNG to Europeans. And again, the Europeans, because they're navigating their own tariff war, they're navigating their own issues and sanctions with Russia, and they're not necessarily going to do business with China because again, that is not only the logistics but also just um, geopolitical and policy. Like, I guess navigating geopolitics and policy. So this is, and we can make the argument too if I'll digress slightly, like you can make the argument too, yeah, it's still got to cross the Atlantic Ocean, but this is just an alternative source of natural gas of energy for Europe, for Western Europe. So, I mean, this could be a huge game changer in terms of shifting the supply, like just shifting, and I mean too, like Canada with the you know there's a lot of debate, I guess, about the melting ice caps, global warming. There's one positive. The risk of being controversial, there is one positive thing to global warming. If the ice caps are really melting, you know, new trade corridors will open up in the north, and Canada has a strategic advantage in that. In that it can send its resources to northern and western Europe. Uh, Through this opened up trade corridor. It also Canada will, it being part of the Arctic, being one of the Arctic Circle nations, will have significant control over a large portion of the Arctic Ocean and the North Atlantic Ocean, and again the North Pacific. And I mean, and with the U.S. help, and with the U.S. The Pacific Ocean. So this is a significant game changer. Now, where does I mean, the, what this does for, I guess, to kind of tie it back to geopolitical risk and what this has on our portfolios. And again, before say this, I'll close up with this. I'll I'll put out that this is not investment advice. This is not. This is just pure, like, looking at an issue. I'm just analyzing it. So please consult a licensed advisor before you consider any of this. But there's oh it I'm trying to phrase it in words here. Like, go back to, where is it? Geopolitical. This. I'll go to global indicator, and I'll kind of go back to this, and I'll tie it back to this. But when you when if there is, I guess, and I'll tie, and I guess, remember earlier in this live stream, and I'll close with this. But earlier in the live stream, we spoke about how this is kind of a lagging indicator for this is a like geopolitical risk is a lagging indicator. So, for example, um, we only tend to see the effects of geopolitical risk post. I mean, because it's a market reaction. It's kind of it's a market. Geopolitical risk should be considered more of a market sentiment towards what's happening in current events geopolitical. So it's essentially quantifying how we can look at these how we can look at these global current events and see how these affect the broader market. And so I guess the new funding of this new LNG terminal in Newfoundland and Labrador, this new funding of I guess the three terminals the two of them that are coming online, the Kitimat terminal that's already online in BC, and then again, of course, I think that's going to reduce a lot of this geopolitical risk. That will actually, I think that's going to help smooth out some of the volatility we've seen in the market, I guess reduce some of that. Reduced volatility has its downsides. I mean, reduce volatility could also mean that we're going to see less overall, or we could also see less opportunity for a large arbitrage in the market. But at the same time, a lot of these events are unpredictable. A lot of these things don't you can't really predict foreign policy the same way you can predict the same way you can use the same way you might. I mean, debatable. The same way you might be able to look at cyclical movements in the market in a commodity, for example. But what's cool about this is a lot of the developments that we're seeing with Europe and the repositioning. I think a lot of it's short term, and we're gonna and it's more and a lot of these things that a lot of these trade dynamics that we're seeing play out are in the long run, they're gonna be for the better. We're gonna see a lot more with the Canadian terminals for LNG, we're gonna see a lot more reliance on Canadian LNG. It'll make Canada a far richer country, and it's gonna I guess it's gonna only benefit companies in Canada, that publicly traded companies in Canada that are operating within the sector as well. So there's a lot of upsides to this. And again, whether you're investing in the equities of the companies, if you're investing in those equities, your portfolio is going to do better, because these are, again, they're almost operating. It's like taking advantage of an open market, of a position in a market. Like, there's a void, and the Canadian government's trying to fill that void. And yeah, so I mean, without digressing, a lot of this is going to have in the long run. It's going to provide more of a. It's going to smooth out the volatility. What it will. I don't think it might not be permanent, at least for the short term, we're going to see the volatility is more just a reactionary. Is more of a reactionary sentiment. In the long run, we're going to see more of a, again, smoothed out. Anyways, if you like this, thanks for tuning in. If you like this, don't forget to tune in next week. And don't forget the Commodity Bro podcast every Monday at noon. And yeah, if you like this, don't forget to like, subscribe, and turn your notifications on so you never miss an episode.